On a one-year basis, right now, silver's up about 40% and gold's up 43%. Now, that's time stamping right now. That's a bad sign for a risk asset that its beta is tracked by gold. Gold pulls it up or down, and it has 2 times the volatility. It should be up closer to 80%. So I think silver.
Hi, everyone, and welcome to the Alternative Edge Report. I'm your host, Olivia Vaz, and today's guest is Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence. Mike, welcome.
Well, thank you. It's my pleasure to be on, Bob.
Intelligence is the name of the game. I can't wait to pick your brain. I'd like to start with the market first. We've had a lot of catalysts, an election, big catalysts, positively received macro data. The market continues to hit new highs, but it doesn't really feel like it. They're quickly getting absorbed. Why the hesitation?
I think it's that point in time where risk assets get too elevated, and we're facing some major shifts in uncertainty. We have a very mercurial president. We know he's digging into the tariffs. The Doge situation is potentially very much contractionary for spending and excessive liquidity from the government and employment. And my focus from commodities is I see nothing but a global market that's really tilting towards deflationary recession. We can dig in that in a little bit. But also one of the key leading indicators I love, Oz, is cryptos and Bitcoin. And that's a market I think put in a pretty significant peak around 100,000. And there's just a lot of trickle down from things like highly speculative digital assets that have been embraced by our new president.
So you're saying that Bitcoin is basically taking the wheel here and controlling
Yeah.
that hesitation because I've been looking at Bitcoin. When is it going to break out? When is it going to break out? And you're right, it
Yeah.
is kind of acting like the market right now.
Exactly. I used to, a lot of when I wrote my outlooks for commodities last year, I said commodities will more likely go down. They have an inordinate burden on U.S. stock market go up to not go down a lot. So the U.S. stock market went up a lot and commodities still, most of them went down. That was last year. Most of them, except for gold, went up. The thing is that mantra has been shifted over to Bitcoin, the world's most speculative digital asset, with our switch from our current president, who was a former antagonist, now a zealot, putting in the forefront. And I think it would give me one of the best signals I've seen since 1999 of you should be selling when you're yelling. So as we're recording today on February 25th, Bitcoin's dropped down to 87,000. The high is 110. But it's just what's happened with the space. It's the world's most significant 24/7 leading indicator. And as a strategist, a commodity strategist, I can't, for one example, I can't write about gold anymore without mentioning Bitcoin in the same space. So it's the key thing is I'm just very concerned about the whole space being having way too much froth and speculation, and it looks like it's doing what those kind of markets normally do. They revert lower.
Do you have a price prediction for Bitcoin?
That's one thing we're not allowed to do is price predictions, but I can point out key things. I think 100,000 was a significant threshold, and read that for a good reason. As I mentioned, we had a crypto president to flip over. I don't think it gets much better than that. I think the key level to look for support is around 70,000. 70,000 was about the highs, and
Mhm.
before, right around we had those ETFs and the halving last year, and it was right around where it was before the election of President Trump. So I think it's going to head back to that area. I think it's unlikely to stay above 100,000. If it does, it'll be a good sign of risk back on.
Absolutely. And you could see the tie between Bitcoin and the market. Bitcoin was struggling to break out. The S&P 500 was struggling to break out, and then you started to see Bitcoin begin to break down. We could have like predicted the market if we were just keeping an eye on that. So that was a really good observation there. But I want to bring gold into the mix because while these two are battling it out if they're going to lead the market to new highs, we do have gold, which just had 4 years of outflows in their ETFs. Can gold have a golden age in 2025?
So I'm glad you mentioned gold because and Bitcoin in the same sentence. And I'm impressed you mentioned 4 years of outflows from gold ETFs because my job is to make predictions, and sometimes obviously that's a bit risky. I think this will be a first year of inflows, and it's already started, and it's starting to kick in really big, and that just shows you the disdain that most notable U.S. investors have had for gold for good reason. Interest rates are high and U.S. stock market's on a tear. Who wants gold in that environment? But that's shifting now fast. And what we had last year was the biggest ETF launch ever, which I think put a peak in Bitcoin. So now I think it's flipping over to gold ETF inflows this year, maybe outflows in Bitcoin ETFs, and a lot of that will be on performance. And the bottom line, I think, for that to accelerate is U.S. stock market having a continued decline. Now, I fully expect a little bit more normal reversion. Maybe, God help us, we get to 200-day moving average in S&P 500. Haven't done that since Q4 2023. We're way overdue for just a normal correction. That really helps gold. The key thing that's been boosting gold for the last few years is starts with the unlimited friendship between President Xi and President Putin, 2022, and gold's up like 65% since then. It's shifted the world order, and central banks have been buying gold. So I think what's going to happen next is this rock that's been outperforming the S&P 500 from a 1, 2, 3, and 4-year basis today is going to continue to outperform, and particularly if the stock market goes down. And I think that's what's shifting. But I'll end with, I think, what's the most significant thing I point about gold. It's the S&P 500 is very expensive versus gold, but what's very cheap versus gold is U.S. Treasury long bonds. We have a Bloomberg Treasury 20-plus long bond index, and you take that and overweight with, take gold, divide by that index, and gold's the most expensive in about 30 years versus Treasury bonds. So I think that is what might be happening. Is we're getting a little bit of deflation in risk assets. Gold is a risk-off asset, sort of, and that will help things like Treasury bonds. The question is what happens with indicators like cryptocurrencies and the stock market.
How about silver? Do we have can silver follow gold's tracks? Because we're trying. We saw the breakout in GLD, for instance. I'll reference here. SLV for some reason is, I guess, the younger brother, just trying to keep up with the tracks.
The key thing about silver is the central banks ain't buying silver. And I have to use a little nomenclature on that or vernacular, because the gold-silver ratio is a key thing I watch. Right now it takes about 92 ounces of silver per 1 ounce of gold. That's the upper end of the range, but I think it's going to 100. And there's a good reason for that. On a 1-year basis, right now silver's up about 40% and gold's up 43%. Now that's time stamping right now. That's a bad sign for a risk asset that its beta is tracked by gold. Gold pulls it up or down, and it has 2 times the volatility. It should be up closer to 80%. So I think silver is more in the same bucket as copper. Silver is more of an industrial metal every day. It's been demonetized by gold for hundreds of years. And I'm bearish on copper. I'll mention that later if we want. I think copper's peaked. And it's also tipped over to China. Demand pull from China is indicated by their 10-year note bond yield at 1.78% compared to the U.S. around 4.3, shows severe deflationary forces, which I remember from Japanese government bonds when I traded those 30 years ago. And so that's a problem with silver. It's going up on the back of gold, and if gold goes down, silver will go down more. But I'm not bearish silver. I'm just much more bullish gold.
I'm surprised you say that you're bearish on copper. Why is that?
Yes. Well, first we got to start with China. And copper, I'll give you the inside trading link. There's the CME traded copper price. The high on Valentine's Day, February 14th, was $4.84. I think that's the high for the year, and it looks very similar to last year's high at $5.20. Now, first of all, remember, copper is an autocorrelated asset, and it's been bumping up for 5 forever, and then usually drops down to 4 or lower. But when it sprinted last week, it was on the back of a massive spread diversity premium in the CME traded copper versus the LME traded copper. It got to about 12%. That's the most ever. Last year was around 7%, and that's when copper peaked around 520. And that was on the back of a lot of speculation in futures, but it looks like it put in a good peak. And then, so that's the technical, putting in a peak on the back of tariffs. The fundamental is what part of U.S. instituting tariffs and the rest of the world. The U.S. is the largest demand pull economy on the planet, largest importer, putting tariffs on most notably China, the biggest single demand or consumer of copper, is good for the price of copper. So copper, the metal with the PhD in economics, I think is more likely to drop towards 4 or lower. If it stays above that 484 level, that would be great. The highest month-end close ever for copper was $4.75, and that was the month, that was March 2022, right after President Putin invaded Ukraine. So it's got a major threshold, and it always reverts lower. And also, so I'll end with the key thing about copper. So you take the price right now, it's about $4.50, and convert it to a percent. it's basically been almost the same as U.S. Treasury yield, about 4.3% for since 2015. It's a good indication of going of interest rates, and I think it's going to go lower with interest rates. And a good indication is that as the rest of the world's bond yields, the top 5 government bond yields are about outside the U.S. are about 100 basis points below the U.S., led by China, which I mentioned is my key indicator sometimes for the macro is government bond yields. The rest of the world's tilting towards recession. They're facing increasing tariffs from the U.S., which is bad for copper, bad for silver, and probably good for gold.
And when it comes to gold and copper, it seems like you want China and the Fed on your side for that price action.
Yeah,
Brings me back to the Wall Street days. We used to say Dr. Copper, it leads the
you go.
world. But
Yeah,
I'm sure you've heard it as well. But
yeah,
now you're saying that there's going to be a global economic problem. Is that kind of a reason why we're seeing the market start to dip a little bit? And
yeah.
will that follow through for not just a couple months, but are you sensing some sort of, I don't know, going back to the dot-com bubble? Is there a bubble? What exactly would you call it?
So this is another thing I'm willing to make a call on it. I think the U.S. equity market with cryptos attached looks very similar to me to the market back in 2000, exactly 25 years ago. Now, the difference we have now is we do have earnings. Back then, things like Pets.com and thing didn't have earnings, but there ain't no earnings or very little earnings in cryptos, and they're so speculatively excessive. The key thing I like to point out as far as massive speculation is unlimited supplies. There's now about 12 million cryptos listed in coinmarketcap.com. So unlimited supply, and you still have silly things like Dogecoin trading around $30 billion. I mean, that's just too expensive. So I think the whole crypto space is due for lop a zero off the value, which is a pressure for Bitcoin, mostly the tops. And I think that's what's happening in all markets. We're seeing massive froth being reverted. Now, key thing I want to point out is last year, the U.S. stock market added about $12 trillion of wealth, market cap, to its valuation. That's the most ever in history. And what happened? The Fed had to stop easing because inflation remained sticky. And I just say it's silly to expect inflation to go down when you have asset prices going up that much. So now we need them to go down for the Fed to ease, for yields to go lower. And I think that's the whole tilt. I see that in commodities. I think copper's peaked, I think crude oil's peaked, natural gas might be peaking. I think corn has peaked. And I don't know what's going to make for these to go higher, but I can see a lot of reason for them to go lower. The number one pressure for everything would be if the stock market continues to revert a little. And I'm not saying go down. It just go back to a 200-day moving average. That used to be normal. Now, you're a trader. You remember those days.
Of course, absolutely. And we're talking about peaking. You have certainly piqued our interest on these topics. Mike McGlone, thank you so much. Mike is very active on Twitter. You can read his articles from there, and we really appreciate your time. I love the zest. Thanks for joining us today, and we hope to have you back on, Mike.
Thank you. It's mutual. I appreciate being on.
Awesome. Thank you so much, everyone. Again, I'm Olivia Vaz. Thank you for watching Alternative Edge Report. Make sure to like and subscribe for future guests.